This is the Rocket City Retirement Show with Chris Wallace. Chris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Chris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi there, I'm Luann Fulmer, and welcome to the Rocket City Retirement Show with certified financial planner and financial advisor Chris Wallace. He's president of WG Financial Group, and then, of course, also joining us from the firm, Graham Bauer. He is a certified financial planner and financial advisor as well at the firm. Both are here today to give you some really good advice about retirement planning. If you have any questions, I want to give you the phone number. This is how you can reach out to Chris and our team, 256-937-2010. It is a complimentary discovery visit, guys. 256-937-2010. You may call that number, or you can text the word visit to that number, and you can communicate that way and get on their calendar. Remember to check us out on Facebook throughout the week, because if anything happens that's newsworthy regarding, headlines for retirement, WG Financial Group 256. Chris will add things on Facebook for us with some updates. Remember our motto, too. It's plan, retire, and play. That's what we want for you. WGFinancialGroup.com is the website, and our show is available on Spotify and Apple Podcasts. Just search for Rocket City Retirement Show. And I'm so excited to be here with you both. Cris and Graham, hello to you.
Hey, Luann, how are you?
Doing great. Thanks.
Hey, Luann, it's good to be back today.
I know. And what's fun is I got to see you both. I got to see you both last week in my hometown. Yeah, so
That's
that was
right.
fun.
We were out for some training, some leadership team training. So yeah, it was fun. It was quick. It was a quick hello, but it was fun.
Yeah.
But all in the same room is always nice.
Right. It is so fun. Yeah. So anyway.
I wish you could have seen your face when I said, well, are you ready to do radio?
Okay,
you were
sure.
like, what? We're doing radio? Yeah,
Yeah, I know. That's so funny. Yeah, you were teasing me. But anyway, okay, so we have got a really good topic. Oh, really good real talk today. REEL, real talk. Yeah, so I'm excited about this. This was, of course, a link that was shared on Facebook. It's talking about IULs. So I'll let you index universal life. I'll let you kind of take it, Chris and Graham.
Yeah, I'll kind of walk us into it a little bit. So there are tons of TikToks, and I'm not on TikTok, but my some of the people that I follow on some of the other social media channels are, and these reels are everywhere on TikTok that talk about life insurance, cash value life insurance, where you can borrow against them. And you can use whole life, you can use index universal life. One of the more popular ones out there today is IUL. And it's kind of trendy, to say, hey, you should get a max funded IUL instead of a 401k, or you should max fund an IUL instead of a Roth IRA, and why an IUL is, better than a Roth. And there's all these arguments and such. So I just happened to run across one because, the algorithms, figure you out pretty well. And so we're doing these reels and kind of breaking them down. And these reels are they're out there. They're on social media. And actually the one that we're going to talk about today actually had someone else kind of in a side-by-side screen.
Right.
You know how they do that, and then they're pointing and shaking their head.
Yeah.
Right. So so the reel today was on IUL, permanent life insurance. So basically what IUL stands for, just to kind of break it down pretty simple here, is it's called an indexed universal life insurance policy. So the way that I like to describe them are they're kind of a little bit of a hybrid between, I would say, kind of like term and whole life. And in a sense, they're a little bit of a hybrid in a way.
Okay.
They're often confused with whole life insurance because they have the cash value component. So I've run into people where they have the cash value and they think they have whole life, and when in fact it's really just a universal life, or it's an IUL, which is an index universal life. So this particular reel talks about max funding an IUL strategy and basically using it as a lifetime stream of income. And I wanted to kind of get into that. Graham, you may have some other points inside the reel as well. But one of the things that I just wanted to kind of remind everybody that this is a life insurance policy, and there are things that you have to monitor within the life insurance policy So I guess what I'm trying to say right off the bat is it's not a set it and forget it type of a policy. The one thing I would be concerned with if you have this type of policy and you're planning on drawing out the cash value is what if your agent is retired or gone?
Right.
What if they just, because sometimes you have agents just kind of show up and sell the policy and boom, they're gone. Well, what if they disappear? What if they die? What if they retire?
Yeah.
Are you monitoring that policy? Because again, it's not a set it and forget it type of policy. And you got to think about it too. Like, how are you going to deal with that when you're in your 80s or whatever? What if you come down with early onset and you've got money coming out of this thing and then you don't even remember you have it because you got dementia? How's your family gonna deal with stuff like that? I just think it's very risky. I've got some other points too, but I'm going to let Graham talk for a second on maybe some things that he saw, and then we'll kind of go back and forth on it.
Yeah, similar to what you were just getting at. I think, a fundamental issue that I have just with it being a blanket recommendation. Again, not saying that, it couldn't work for some people. I think, yeah, there are certain scenarios where it could make sense, but any recommendation that someone's just giving as a blanket recommendation is usually probably not something that actually is the best recommendation for every single person, because everyone's situation is complex. We all have different circumstances. And I do think that the complexity of these are probably, make people explain them more simplistic than they actually are, because if you just say, oh, do you want something that you can draw off of cash, or you can draw off the cash value tax free, and you don't have to pay any taxes. You won't lose any money to the stock market, and you can get a 12% return or something like that. That sounds really good on the surface. But the actual complexities of the policy, I think, if you got into all of that, you probably make a lot of people's head spin. In fact, it even makes my head spin a little bit when you get really, really, really deep into the mechanics of it. So I think that it's important to try and understand what you're investing in generally. Again, obviously advisors are here so you don't have to fully understand every single little thing about every investment and the tax code and every little thing about Social Security and all that. But I do think that you should have some basic solid level of understanding of what you're investing in, because, you see too many people that come in and they have something like this and they really don't even remember what it is at this point. Like, they took it out a couple years ago and they're like, it's some kind of life insurance. I don't know. It just kind of bought it. I pay X amount of dollars every month. I'm not really sure. I think I can use some money from it, but I don't really know how it works. And certainly don't think of it as a, substitute for the more classical approach to building wealth, as far as retirement accounts, investment accounts, and all of that. So I don't know. I think that the complexities sometimes can make people overly simplify when explaining, and then make it to where the investor doesn't really know what they're even in at this point.
Yeah. The other thing that, they mentioned in this video is, obviously you can take lifetime income, which in and of itself is kind of a false statement, because these policies actually can lapse. So you can pull too much money out of them. Maybe they don't perform at the level that they were illustrated. And that's the biggest problem that I have when we take a look at illustrations is many of them don't perform at the illustrated rate. And it was so bad several years ago that Congress stepped in and they passed a law on, how much could be illustrated. So they kind of put caps on how much agents could illustrate. Because at one time, I think they were illustrating kind of a double-digit return. And let's just be real. I mean, the market, even over 100 years, is going to average right around 10%. I mean, if you got an IUL that they were illustrating at 10 or 11%, I mean, that's just not going to happen. I mean, it's just because there's caps on these types of things. So let's kind of talk about that a little bit. So the individual in the video says you won't lose money to the stock market if the stock market is negative. And that part of it's true. But then you still have inside these policies, you still have the cost of insurance and the internal fees. So theoretically, if you didn't lose a penny to the stock market, that's true. But your balance could still drop in the cash value column because you still have internal expenses and cost of living adjustments coming out for mortality expenses as well. The other thing, too, when we're talking about cap rates and participation rates inside insurance products, especially on the life insurance side, you have to understand as the purchaser of these types of products is that the insurance company holds the strings when it comes to those cap rates and those participation rates. So some of them might give you, say, 50% of the S&P upside. Okay, well, can they change that? The answer to that is yes, they can. They can change that on an annual basis, or maybe it's biannual, depends on your crediting strategy. But the insurance company can absolutely change that. Can they lower the cap rates? Absolutely, they can. And they are more than likely to do that. So I think when you go to purchase one of these products, like I said a few minutes ago, it's not a set it and forget it type product. I think that you have to manage it, because let's just say that we get, 7 years into it, and now all of a sudden your cap rate, which was say 12 at one point in time, let's say they've lowered it down to 10%. Well, that's a pretty substantial drop in cap rate, and that's going to prohibit you from making as much money. It's definitely going to have an impact on the cash value accumulation within the policy, which then will impact the way it was illustrated to you and the rate in which cash value loans can be taken against the policy. So let's just say that you started taking loans in year 2 or 3, or taking money out as a loan in year 2 or 3, and then all of a sudden now the earnings is not keeping up with the projected illustrations, and actually you're ripping too much money out of the policy, and maybe you hit 78, 79 years old, and then the policy lapses and starts to trigger some taxes on some of the policy loans there and the gains within the policy. So you have to be careful. That's why I said it has to be monitored. It's not that they don't work, and it's not that they're not a viable strategy in some cases. And I think that's kind of what you were alluding to, Graham. It's not that they're just like all bad, throw the baby out with the bathwater type of a thing. Don't dismiss them totally. I'm just not in favor of the blanket coverage, is what you said, like the blanket recommendation here, because the way that the reel was done, the little video there, it was done in a way that it's great for everybody. And I can tell you with like a 12% cap rate, that's, minus cost of insurance and fees, you're gonna make more in the market long term. And this is really pitched really well to young people. I feel like these videos kind of speak to young people really, really well. And they are more likely to buy into this type of policy when, if I'm talking to a young person, say in their 30s, that's not our core market. There's core things that we think a 30-year-old couple should do. And one of those would be to buy outside the job term life insurance, not buy this hybrid IUL policy and invest in it for tax-free loans. It's buy term life insurance and invest in your employer-sponsored retirement plan. And if you want tax-free money, then do the Roth, especially when you're maybe in your early 30s and maybe even middle 30s when you're not at your peak earnings. So again, that's where I tend to have the problem is the blanket recommendation here. Mm-hmm. And I've said it before, Luann, this is why we started doing real talk on the show, is these little videos are done really well. And they're so interesting. And these social media sites have really figured out how to make these clips, grab your attention. And the next thing you know, you click on a couple of them, and now your feed is full of them because I call them the algos. They've got a hold of you, the algorithms, and you can't get rid of them. And then, once you hear things over and over and over again, you kind of start to believe it. I mean, that's just the way our bodies and minds work. So I don't know if you have any closing thoughts on them, Graham.
Yeah, a couple more things I'll just mention. I mean, I think if we're being really honest about probably what a lot of the motive is here, especially for young people, is, from an insurance perspective, if as an agent, or from even an advisor perspective at some of like the brokerage firms, especially, for a young person walking in the door, there's usually not a lot of revenue generating sources because most advisors make money by managing assets. Usually young people don't have a whole lot built up yet. They're kind of just getting started out. And so things like this are a lot of times, I think, a blanket recommendation just because it is probably the easiest way to, get a high commission rate on something that the person can realistically get into. But to just go back to that Roth IRA versus IUL, or we can even say Roth 401k. If we're just going to compare apples to apples here really quick. So, like for comparing like just some pros and cons. So, like IUL versus Roth IRA / Roth 401k on, how, I guess I'll use the word user friendly it is. I would say that the Roth IRA wins every time. It's very simple to understand. Very easy to set up, very easy to move money around, structurally much, much more simple, even though, they do have their own complexities. And then from like a fee and expense standpoint, as long as you're investing in, lower cost ETFs and, individual stocks or just low cost ETF positions in general, your fund fees and total fee inside that Roth IRA or, 401k is probably going to be much, much, much lower. So I think it wins there again. On the tax-free growth side of things, again, I think you're going to probably make a lot more in a Roth IRA over the long term, because even though, it can go down, you're not guaranteed against loss, you also have a lot more upside. I mean, if you look at just the market over the last 5 years, obviously it's been a bumpy last 5 years in a few spots in 2022 and in the last couple months. But even still, we're up pushing 90% in the last 5 years, which is, not the same growth you would have seen. So I think in pretty much every measurable category you can put it in for a young person, at least, it makes a lot more sense to, be a little bit more aggressive with your money, have it in a Roth IRA. It's still growing tax-free. And one more thing to mention, from a liquidity standpoint, it's also the better option because you can get your contributions back out of a Roth IRA if you need to. If you put $8,000 in there, you can take that $8,000 back out. You can't get to the earnings without, taxes and penalties, but those contributions stay pretty liquid. So I think if we're just comparing one to one, if you were going to give a blanket recommendation, which I don't think you should do, because even in that scenario, I think even for a young person, you could have the argument of Roth versus pre-tax brokerage, whatever. There's pros and cons of all of them. But I think if we're just going to stack one-on-one and we're looking for tax-free growth, you're going to be much better off in a Roth long-term.
Wow.
Yeah. And if you haven't, if you didn't catch the show, I don't know, maybe a month ago, I had somebody call in the other day and ask for, the show episode where we did the order of operations. So, and we talk about where we think young people should save. And the reason as you were talking, I thought about this. The reason I think young people, they can get caught up in a commission buzzsaw real quick. And the reason for that is a lot of times they want to do the right thing. The couple, let's say you have, Mr. and Mrs. Smith, they want to do the right thing. They want to save for their future. But a lot of times a financial advisor can't work with them at the time because, and when I say can't work with them, meaning all of their assets are in their 401k. They don't have much saved in outside accounts, and they're kind of just getting started. But if they go to certain firms or certain people, then they get caught in that commission buzzsaw because the advisor or insurance agent that's meeting with them, talking with them, they can't make any money off of them unless it's commission related. So I think young people are very vulnerable when it comes to that because at times I don't think they know any better. And people who pitch these types of products are really good at pitching these types of products, and they make it sound like it's the end all be all.
Right.
As we start to wrap up Real Talk, and it went real long this week, but this is a very popular product out there today. It's pitched at a lot of dinner seminars. It's pitched inside of advisory offices as kind of the end all be all. I've even heard people taking money out of retirement plans and funding these things. And I think that's silly. I think if you're going to take money out of a retirement plan, it should be in the way of a conversion to a Roth IRA, not to fund an IUL for life insurance, but that's just my opinion. But the other thing is the premium. To get the cash value to really ignite and grow in these things, you have to put a lot of money into them. So that becomes the problem that Graham and I have is, are they the person that's selling the policy to said couple? Are they, basically, are they charging or asking the couple to put in a tremendous amount of premium because ultimately impacts their commission? The agent actually makes more money. Here's what I would do if you are approached with one of these, and somebody's asking you, because I'm not joking when I say this. Sometimes the annual premiums can be anywhere from $10,000 to $20,000, if not more, that these agents will want you to put into these policies because, again, it gets the cash value kind of ignited and growing. The question I would ask them is really simple. You don't even have to write it down. It goes something like this. Let me see your policy.
Mm-hmm.
And let me see and let me see what kind of premium you're putting in. There's really those couple of questions. Let me see your policy and let me see where you're putting in $20,000. Because if it's good for me, I'm Mr. Smith talking back to the agent now. If it's good for me, it should be good for you, right, Mr. Advisor? So let me see where you're putting in, 10, 15, 20, whatever the number is. I'm all about transparency at the office. I'm not going to say that I do every single thing that the clients do, but I'm pretty well in line because of my age bracket right now with a lot of our pre-retirees and retirees. And when I say I don't do every little thing, because I'm still not quite 52, I will be in a few weeks. But ultimately, I'm prepping for retirement. So I'm doing my HSA. I'm maxing the 401k. I'm saving in an after-tax brokerage account at this point. And I'm doing things to try to help myself in the near term in taxes and in the long term in taxes. And I'm also planning for my retirement. And guess what? It does not involve an IUL. Shocker. All right. Shocker. We can move
we
on.
only needed 20 minutes to get to that buildup. If you guys we're just on the edge of your seat waiting for the big reveal.
Yes. And again, like we said earlier, it does not mean that it doesn't work for some people. There are very specific, situations where I think they could work. But it's not the end all be all, and Cris Wallace doesn't use one.
Okay, good to know. Thank you for this, because very impactful the way you guys explained it all. So indexed universal life insurance is what we're talking about in real talk today. And that was a good segment. Thanks, guys. So, all right, I want to move on a little bit in our topic right now, just the fact that we've seen a lot of market volatility. So a lot of retirees are like, I got to think about parts of my income that aren't going to rise and fall in the market. And that, to me, means Social Security. So, Cris and Graham, I want you to share with us how we can get the most out of Social Security, especially in an unpredictable market like we've been seeing. Let's talk about how Social Security can be a lifeline for retirees when the markets drop.
Okay. So, yeah, you're right. It's not subject to volatility. And we feel like it's one of our core strategies at the office is the decision on when and when not to take Social Security. So really, the quickest way to get more is to wait. It's pretty simple nowadays is you just wait. And I think there's different reasons for waiting. We've talked about a number of strategies on the show before in previous shows why we think someone should wait from a tax perspective, from a spousal protection perspective. There's several reasons why we think people should wait. But I'll also say this. I also believe that during a time of severe market volatility, if you're having to, pull more than the normal out of your retirement account, you can see Social Security as kind of a safety net in a way, meaning you can turn it on a little bit early if you have to. Because if you're pulling a lot of money and now the market is dropping or incredibly volatile, let's say the market is down significantly, then I think it's worth having the conversation in your reviews with your advisor to go, okay, like our portfolio is down, I'll make a number of 22%, and we're supposed to start pulling soon. We're now 65, so we're just a couple of years away from FRA if it's 67 for this couple. Should we go ahead and think about turning it on a little bit early to give the portfolio time to breathe? Not sure I would do it at 62, but I think it's definitely a conversation the closer you get to your FRA. So that's one way I think it could be a lifeline. I don't know what your thoughts are on that, Graham.
Yeah, again, just any guaranteed income source that you have is certainly going to be a lifeline against uncertainty, or just a comfort to know that you have it. And to be perfectly honest, for people who are not on Social Security now, it is not uncommon that people's Social Security amounts cover most of their living expenses in retirement, at least maybe after a few years. And that's not a blanket statement for everyone, but for a good bit of people, I would say that, Social Security a lot of times will cover some of the basics. It's probably not going to cover the basics plus all travel expenses and new cars and all that stuff. But, for your basic paying for gas and groceries and things like that, I would say it's not uncommon to see, between the husband and wife to kind of get to that amount. So I think for a lot of people that is a comfort. And just in general, the people we see, if we're just branching out of Social Security, even with like pensions and, maybe you got a few pensions, disability payments, Social Security, anything like that coming in. those people tend to stress out less about market drops in general because, hey, well, if the market goes up or down, it doesn't really change how much income I'm getting. I still have a lot of income coming in.
Right.
So, especially in Huntsville, there's all, federal employees, military. So there's plenty of people out there, probably people listening that are retired military that will also retire federal government and have Social Security. And for, people in that situation, that's a really comforting thing. Even if you feel a little bit stressed about some of the volatility in the market, if hey, I got a really strong base of income coming in here, that is certainly going to, help you sleep a little better at night.
Yeah. Graham, you just hit the nail on the head when you talked about the pension and the Social Security, and those individuals that typically have both, they do tend to stress less. It's a lot like when you're working. Like if you're working and you're not knocking on the door of retirement, let's say you're 15, 20 years out, then you're not worried about what's currently taking place in the market. You're like, that's fine. I don't need the money right now anyway. Well, if you're a retiree and you have really solid guaranteed income, like Graham mentioned, it's the same thing. What you've done, essentially, if you think about it in very simple terms, is you've created a longer time horizon. You have that with your job as long as there's income, and then in retirement, as long as there's stable income, you can also recreate that retirement time horizon, or that in the investment time horizon as well.
What should people know about spousal or survivor benefits of Social Security?
Yeah, that's a pretty detailed one in terms of just there's reasons to claim early for some. There's reasons that we've talked about to keep up with your ex that you were married to, because, I've run into situations before where I've seen somebody that has an ex-husband and they're deceased, and that gives them the opportunity to claim off of them if they didn't get remarried before age 60. We've seen some wild stuff. Actually, in the past year, we've seen some really, really wild stuff that I think other people, and I say other people, other advisory firms have overlooked because they don't look at the detailed planning aspect that we tend to look at. And I don't think people ask enough questions, but you need to be aware of what are your options, especially from a spousal claiming standpoint. Should the high income earner wait? Should the low income earner go ahead and collect? Age plays a big deal in the decision as well. And then, like I said earlier, if you've got a spouse that's passed away, what do you do there, and what's the best option? So, like I said, we've just seen a lot of things come up in the past year where Social Security just really is a big decision. And maybe it is a cornerstone in somebody's retirement plan because it is a guaranteed stream of income. It is an inflation adjusted stream of income. It's one that we feel like you should take, very seriously when you're thinking about making it. Stay out of the headlines, because the headlines will tell you that it's going broke, and that's not a lie, but it'll also sink into your brain, that there's this fear going on, and it'll trigger some emotion. And a lot of times when all that starts running through your head, you can end up making a bad decision. So we just recommend people come in and sit down with us, and let's just have a simple conversation, kind of like we're having right now, a very easy conversation about your retirement plan. We can figure out how to build it out so that you have the best chance to not run out of money in retirement, figure out how to get your taxes as low as possible, figure out how to really just make sure that you can go out and play. And that's big with us. Plan, retire, play. We want you to just go out, play, enjoy the last phase of your life with your spouse and your family or whomever you want to. But one of the things that we want people to not do is sit there and stare at their accounts all day. That's not healthy for anybody, especially during times like this. It's build out your plan, have trust and faith in the plan, and let it rock and roll. Our number is 256-937-2010. If you're listening to this on the way to church, you can still hop out to Apple Podcast or Spotify and catch the whole episode. This is only the first half, so we're going to keep going.
Market difficulties can be unsettling, but your retirement plan doesn't have to be. Take control by calling Chris Wallace at 256-937-2010.
Quarters, just 25 cents. That's hardly anything, right? But Chris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Chris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Chris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Chris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
If lingering doubts like, have I saved enough? Or will my retirement funds endure? Are on your mind, it's time to consult with Chris Wallace. Text VISIT to 256-937-2010. That's 256-937-2010 to book your appointment and get the answers you need.
Yes, and we do thank you so much for joining us today. This is the Rocket City Retirement Show with my friends Chris Wallace and Graham Bauer. Chris is president of WG Financial Group, and they both are certified financial planners and financial advisors at WG Financial Group. So when you call them and you ask them questions about retirement, boy, they have the answers for you, or they'll find the answers for you. So they both have licenses, the education behind them, and they are very good at what they do. Plan, retire, play. That's what we want for you. We want you to also have some M&M money, some making memories money, and we're going to get into a little bit more of that right now. You know, when you look back to when some of you are retired. Some of you are still working. So retirees, remember when you were working, right? And you were getting that regular paycheck every single month or 2 weeks or whatever. And that predictable income, once you retire, is, really replaced by just having to figure out where you're going to get your money, taking it from your portfolio, right? But then you worry about all the markets and all that. Retirement does not have to be that way. That's why we are here, every weekend on our show talking to you. And so I want to talk about why we need to create dependable retirement income. It's so important for retirees. Chris, I'll start with you.
Yeah, so we talked in the very first segment. We did our real talk on an IUL and why I thought that was not what I would consider a dependable source of guaranteed income. But dependable sources of income can do a couple things for people. Number one, it can make you it can make you relax, when the market starts getting a little volatile, because you have steady, predictable income coming into the household. So it can make you relax a little bit more. It can also give you that, feeling, knowing that you have a longer time horizon out there in terms of your investments. And we mentioned that just a few moments ago, where, having that stable income where you're not having to pull out of a portfolio, because that's the thing you don't want to do. You want to try your best not to be pulling large chunks of money like during a recessionary time where the market's off, say, like 30%. There's going to be volatility, and it's always best to try not to pull from an incredibly volatile portfolio, because now you're introducing that sequence of return, and that can take the portfolio a little bit longer to recover. So having that stable income is really important. The other things that I think we need to think about in terms of stable income is people are living a little bit longer, so we got longer lifespans. So that means that retirement savings has to last a lot longer. And those pensions that Graham mentioned earlier are becoming more and more rare. They're like dinosaurs nowadays. Whether you're military, federal government, you have one. But if you're an older employee with some of the old bigger companies out there, you may still have one. But newer employees are not getting the benefit of having those pensions. And then we've also got rising healthcare costs and inflation. So having those predictable income streams to cover expenses, we feel like is just really important.
All right. Now, we keep hearing retirees worrying about whether their savings is going to last. Okay. And so, you have these market volatilities that we've been seeing. Of course, inflation concerns, things like that. Let's talk about strategies you guys use to help people ensure you're going to be okay. Your retirement income is going to last as long as you need it to. Tell us about that.
Graham, you want to start with that one, or you want me to?
Sure, I can start with this one. One thing you mentioned on the last question is, the lifespans of people living longer. And that is something that's really hard to predict. Obviously, how long you're going to live. We've said before on the show that if we knew how long everyone was going to live, it would make our job way easier. You could plan for things so much better if you knew the day you were going to die. Not that would make your retirement more enjoyable.
Or your life.
Yeah. You'd probably just be
literally
just staring at the clock all day.
Counting the days. Yeah.
Yeah.
You know how people have retirement counters on their computer or their phones? There are some people listening to the show, because there are some negative people out there for sure. They would have the death counter.
That is
pretty
awful.
much.
On their phone.
That is awful.
And we've heard people say many times, like, when I turn 75, that's it. Like, I just know I'm not, 70, 75, I'm not making it that long. I'll be gone.
Yeah.
Which-
Bobby and I are like, okay, the shoe's going to drop. We've been so healthy and blessed. We're like, this is terrible. We're both 65. The shoe's going to drop sometime. We just know it is.
Well, people are living longer and longer. Medicine gets better, and, we can cure more diseases and things like that. So you want to plan for longevity.
Yes.
But I think a scenario that I've run into a few times over, really over the last few years, but it's something you always see is, something where one spouse is a good bit older than the other spouse. Talking about, maybe a 10, 15 year age gap, something like that. And, on the surface, even if we're planning for just a normal life expectancy, that is really, really going to extend the life of your retirement. Because if, one of you if the older spouse is working and they retire at, 65, but the younger spouse is only 52, then your retirement time horizon for, planning purposes isn't, 25 years to 90. It's really like 35 years to 90. Because if you're going to 90, because you got to make sure that obviously there's enough money, not just for you, but your spouse. So that really, really extends the period that you have in retirement. So I think in situations like that, you got to be a little bit flexible, especially early on in retirement, because you have to acknowledge the fact that, even if you've saved well, you need your money to last a long time. So, I mean, if you retire at 85 years old, I'm not going to tell you to use the 4% rule, most likely, because it'd be pretty hard to, use the 4% rule at 85 and get anywhere near spending all of your money, or even probably, a significant percentage of it. But for someone who is, younger, or they have a younger spouse, it's definitely something you need to be mindful of is, not just how much you're spending, but when you're spending it. Like Cris talked about a little bit earlier, if we're going to maybe buy a new car and it's a down year for the market, is this the right time to do it? Because we have, a really long retirement time horizon. If we're pulling significant amounts out of a down portfolio, that just makes it that much harder for it to recover. And, introduces a lot more long-term sequence risk. So I think that you have to be a little bit flexible, especially early on. As you get further down the line, that risk drops off a little bit as, returns have been a little bit more predictable, and some of your retirement at that point becomes history instead of future. Like, a little bit more how it's gone so far. You're not at just the cusp of it. So for that reason, I mean, having dependable income sources is the absolute best bet you can have. So that looks like Social Security, obviously. That looks like pensions. That could be annuities. And, in this scenario that I've mentioned of having a much younger spouse, or even just retiring early on, that's a common scenario where some type of annuity for income could genuinely help you long term, because you're taking out a little bit of that market return risk over a very, very long retirement time horizon instead of a short one. So I think for those people, people retiring younger, people with younger spouses, there's a little bit of a heightened risk. But for everybody that retires, just flexibility with your spending, how you're spending it, and when you're spending it is very important.
Yeah, and I think that the number one fear, as we've kind of mentioned, is running out of money. But I think the reality is even though that's the fear, because that's the psychological side of it. When you quit working, you're like, oh my gosh, I don't have enough income anymore for my job. And, do I have enough from my savings? And now I have to learn how to pull out of my savings, and that feels weird. So that's the biggest fear. But I think two other fears that really bother people are just the threat of rising taxes and the threat of long-term care. I hear that all the time. And most people that come into the office, it's, do I have enough? That's a pretty common one. But the other two that I hear a lot of are rising taxes and also long-term care. And those I think are harder to control in some ways. And I'll kind of unpack that a little bit. One, in terms of running out of money, Graham, you're talking about the 85-year-old and the 4% rule. I've always said that, it's kind of weird how the older you get, they say you should become more conservative. And I'm like, nah, it should be the exact opposite. You're going to die sooner. So like if your goal is to spend all your money, get more aggressive. I'm not saying for 85-year-olds out there listening to the show to go invest all in stocks, but from a mathematical perspective, that just makes sense. Less life expectancy time. Hey, spend more money. But when it comes to running out of money, I think you can make adjustments. So I think if people are worried about that and you notice your balances are starting to drop, well, guess what? You don't take as many trips a year. You don't buy the car, as Graham said. So you can kind of throttle your spending a little bit as long as you're covering, your basics. But the rising taxes part of it, like, I don't think there's a lot we can do about it unless you do proactive tax planning in your retirement plan. But once you get to 73 or 75, you're going to take money out. Government's going to say, hey, hand out, give me your RMD. It's time to take it. And there's nothing that you're going to be able to do about that. And if taxes are higher at that point in time, you can't do anything about that either. You've got a specific percentage that has to come out of the IRA at RMD age, and there will be specific tax brackets in place, and you can't adjust that. Where I was just talking about with your spending, you kind of have a throttle. You can throttle that a little bit. You can't throttle those taxes once things are set in place. And then in terms of long-term care, if you're so bad off that your spouse can't take care of you, you're probably going to end up in a home. And the home is going to cost, what it costs. You're not going to be able to go in there and start negotiating. It's not a used car lot. You're not going in there and saying, I'll give you, $6,200 a month for that private bed over there. It doesn't work that way.
Yeah. Throw in some weatherproof mats too.
Yeah, exactly. It's not going to work. So you can't really throttle that as well. So having proper coverage in a lot of cases is best. There's a lot of talk about when to get long-term care. I'm of the mindset, I think it should be in your middle 50s, and you should start looking at that now. There's good ways to do that. Ironically enough, we were talking about life insurance at the beginning of the show. I think those strategies for long-term care tend to work well because somebody wins. Well, I don't know if I'll call it a win if you end up in a nursing home, right. But if you have the policy and you need it, it's a win. You have the policy. It's not a win that you had to go in a nursing home. And then if you don't use it, which is a fear of a lot of people, I may pay for something that I don't use, and then my family doesn't get anything, and the insurance company keeps all my money. Well, if you're using a life insurance policy strategy, then, if you need it, it's there. If you die with it, somebody else gets the money. So it kind of, fulfills the wishes of the person who bought it. Yeah. So I think there's other things in retirement, believe it or not, that carry, I won't say as much weight psychologically, but it carries a tremendous amount of weight, and that's the rising taxes issue and then also long-term care.
Okay. Love it. Thank you for that. Real quick, I want to give out your information so people can make sure and give you a call if you have questions. Here's our phone number that we want you to have, 256-937-2010. You may call that number, or you can text the word visit to get on their calendar. WGFinancialGroup.com is the website. You can head there as well. While I'm giving out numbers, I want to mention that Cris is offering a chance to come to your place of business and do some lunch and learns. Okay, so if you're the owner or you're the president or HR manager, Cris would welcome the opportunity to come talk to your employees about retirement. So he's doing this complimentary for businesses here in the Huntsville area, and he would love to help your employees better understand all the complex things that we talk about regarding retirement. And we'd love to help them out. So the number again, 256-937-2010. You can just ask for that complimentary lunch and learn. So we're talking right now about how to create dependable retirement income. And this is something that you guys, man, this is sort of your forte. I want you to explain how you guys, you work with a couple or an individual, they come in, you help them analyze their income needs, right? So they can have that, monthly paycheck and come up with that reliable strategy.
Yeah, I think one of the first things that I see a lot before we kind of dive into this a little bit, we'll have people come in with spreadsheets that they've run, and they essentially just have like a linear return. I know, Graham, you've probably seen this as well, where They have their starting amount, which is kind of their ending working year balance, I guess, but starting amount for retirement. And then they just kind of tack on a 4 or 5% return. And their thinking is, well, if I just draw 4% and I've got a 5% rate of return, then my investments grow by 1% a year. And that's just not the way it works. It works that way if you have all of your money in a CD making 5% that's guaranteed for the 30 years you're going to be alive or potentially be alive. Then it would work that way because you're literally getting like guaranteed, 5% every single year. But with the market, you're not getting that. You're going to have the ups and downs, and the ups and downs are really going to be based on obviously economic factors. It's also going to be based largely on your standard deviation of your portfolio. So that up and down movement that you'll see, in a portfolio of bonds and stocks. And so you're going to have inevitably, you're going to have some down years. You're going to have some up years. So your returns may not quite look exactly like them on the spreadsheet. And that's what I've seen quite a bit when it comes to figuring out like returns and how long money's going to last. The other thing that I see on spreadsheets is tax rates being figured incorrectly. I've only seen one tax sheet by an engineer that was incredibly accurate. Matter of fact, I work closely with a tax person on some of our Roth conversions and such. And I was at a fundraiser with him the other night, and man, we were just kind of talking about his tax spreadsheet, and we were just amazed at how accurate it is. It's within a few dollars of what he uses in his tax software.
Wow.
Yeah, so it's pretty amazing. But it's hard to do, and a lot of times people don't understand all the different spider web of taxes that the IRS kind of has set out there to kind of capture you in and cause you to pay a little bit more tax. So I think when we're sitting down with a family and looking at an entire retirement plan, in order to figure out like what kind of income we need, we first need to figure out how much is going to need to go out the door. And we've had people come in the office before and they'll say things like, Chris, we just make enough money. We don't really budget. We just have enough money that comes in, and yeah, I don't really know. I don't really have anything written down. And so I'll ask a few more questions. And then what we try to do is we try to tailor the plan to their net income today. Because if they're spending, because I've seen this before, they say, oh, I'm spending everything that I'm bringing in. And that's fine. That's okay as long as you're hitting your retirement savings marks and what comes into the spendable account gets spent. That is totally fine. But we need to recreate that in retirement. So if they don't have a budget, let's say they have a net income every single month from work before retirement of, $7,000 a month, then that's your budget. That's your lifestyle. And that's the lifestyle you want to go into retirement with. You don't want to go into retirement being used to spending $7,000 and then figuring out, oh no, I need to drop down to, $4,000.
Oh, heavens no.
No, that's a radical lifestyle change. So figuring that out, what goes out the door is important. Understanding the tax side of things, what types of income buckets are we going to have? Do you have all pre? Do you have Roth? Do you have some capital gains? Do you have any liquid cash and savings? All of that's important, in building a strategy. And then, some people think that they're okay being more aggressive. And sometimes our softwares will kind of say that, due to a higher volatility in the way that you think you want to be invested, it actually causes a problem. So that is also part of it as well, Luann. So figuring out what goes out the door. Let's looking at the tax side of things, the income side of things from Social Security and pensions, and then also that portfolio volatility all makes a difference in determining how we may recommend that a family set up income.
And I want to give one quick little tip, I guess, for people out there who are maybe thinking about their own spending and aren't really exactly sure where they are. And this is a very simple tip, but this is the way that when someone comes in and we're doing a discovery session, I'll a lot of times kind of look at it to see where they're at. So if, for example, if you're a married couple and let's just say your gross income between the two of you is like $200,000 a year and you max out one of your 401ks, and that's kind of the investments you do. That's you're hitting your savings target in there. That's the investments you're doing. There'll be people in that situation that'll come in and say, maybe we spend like $4,000 a month. We're kind of frugal. And so I think a really good thing to look at would be, do you have a large chunk of cash building up in savings every month, just in your checking and savings account. Because if you're only investing in your 401k and you're supposedly only spending $4,000 a month, where's the rest of the money going? And sometimes the answer to that is yes. But if it's not, then your expenses really are just whatever your net income is. Whatever's hitting your bank account is what's coming in. I was even sitting down with someone recently and, kind of talking about expenses, and they're alluding to, we spend, maybe we spend like $5,000 a month. We're pretty frugal with spending. And as we kind of dug into it, it didn't really have an emergency fund built up, and, started talking about net income. And it's like, okay, so you bring in, $8,000 a month net. Let's just throw that number out there. And none of that's really flowing through back to savings. So in all likelihood, you're spending $8,000 a month. Like, that really is your lifestyle, because we tend to think of it as just, oh, this thing, that thing. There's, what is it? Water, utilities, food, and that's probably it. And we forget about the fact that we, go on vacations typically. And if you have kids, there's a bunch of random stuff that pops up.
Amazon.
Yeah.
Amazon.
Amazon.
Yeah.
So, yeah. So anyways, I think that that's an easy way when you're just looking at your own spending to kind of take a look and say, if we're not having a balance build up in savings and we're hitting our targets other places and not doing any other investing, then our expenses really just are our net income.
Yeah. It ends up being pretty close in a lot of cases with a lot of people. You mentioned something else too, Graham. If you have money, like excess money, you used a couple that was making about $200,000 a year, I think is what you said. And
just as an example. Yeah,
exactly. And so now they have a high savings balance, for example. And you're not doing a Roth IRA. You should be transferring money out of your savings into a Roth IRA. So I call it moving money from your right pocket to your left, and you're moving it from taxable to not taxable. I ran into somebody a few days ago. I think could have even been yesterday. And I was just asking some questions, and the gentleman said that he doesn't currently do a Roth. He's pretty close to retirement and just it's too late. And I was like, it's never too late to put money in a Roth, like ever too late, because it's in your savings, and it's in your savings getting assessed taxes every year on the interest that you earned. So you're much better off tax-wise to take that money and put it in a Roth, so that it removes it from being taxed ever again. Some people think, well, it is too late. No, it's not. I mean, for you and your wife, it's $8,000 a year if you're over 50, so it's $16,000. You can move from savings to a tax-free Roth IRA. Well, I don't want to invest it. How much does a Roth? I don't know if do you get asked this sometimes? Well, how much does a Roth make?
Yeah.
Okay. Yeah. It's like. Depends on how you're invested. It can make like a CD rate, or it can make S&P rate.
Yeah, but I mean, and I had this conversation with someone not long ago. I was like, even if you just sit it in cash, which is not, again, what I would recommend to do, but if you just sit it in cash making 4%, it's still better than letting it sit in your bank at 4% in cash.
The last time I checked, Graham, you may fact check me on this, 4% tax-free is a lot better than 4% taxable.
Yeah. Any day of the week.
Any day of the week, right? So
right.
Anyway, we're just full of tips on
a lot of great information. Bottom line is, though, you have to have an income plan. You have to have also money, hopefully left over for growth, because you need some of that money to grow once you're in retirement. So you've got that monthly or whatever paycheck coming in, and you've got the growth plan. You have that written retirement income plan. That's what you guys do for a living. I do want to get into these taxes, because it seems like some retirees are a little surprised by taxes in retirement. For some reason, they were assuming their tax burden would be a little lower in retirement, and that's not exactly the case. So why don't you guys talk about just what soon-to-be retirees or even current retirees can do right now, because we know taxes are going to go up in the future. We're not for sure. Maybe 2026, we don't know for sure. But anyway, talk about that for a minute.
I want to back up just real quick to kind of talk about what we were talking about, moving money from savings into a Roth. Obviously, you have to have the correct modified adjusted gross income in order to be able to do that. But the point I wanted to make is our report card that we utilize during our process will actually show you kind of what you should and shouldn't be doing. It'll identify strategies that you should take advantage of. And I think that's probably one of the great things about what we do is how we lay out the report card, how we lay out the plan for the client. Is it makes it really simple to understand and really to intake a lot of high level knowledge in a shorter amount of time just by keeping it pretty simple and not really diving into the weeds. But our report card is probably one of our most popular things that we do and that we share with clients. So, Luann, you mentioned taxes. Yeah. We don't know. We don't know what's going to happen. I mean, right now, I don't know if there's going to be a tariff tomorrow or a tariff today or a tariff in 15 minutes. So things are a little bit erratic right now, and it's making the economy kind of crazy. But at some point, that's Trump's baby. So he's got two, what I call ego barometers. One of those is the stock market. That's one of his ego barometers, and the taxes is another ego barometer. So, I don't think he wants to see the stock market crash, and I think he'll change his tune and tone, should that start to happen. But here, sooner than later, they're probably going to have to do something, or he's probably going to have to do something about trying to get the extension done to the tax code to try to make some things permanent, because as you kind of alluded to, at the end of 2025, it is going to sunset, and we know what it's going to go to, and it's just going to go to the previous brackets where Obama was in office, unless there's some sort of an extension. We can make the assumption over time. We can, I think we can probably all agree that taxes are probably going to go up. I'm not one of these negative Nellies where I'm saying that it's going to go back to what it was in the late 1940s after World War II.
Oh, hope not.
I just think that would be a little bit crazy to have a top marginal rate in the 90%. We're just in a different time at this point, and people out there probably say, yeah, but look at our debt, and it's like, okay, well, if it is, it is. We're all in that sinking ship together. So I try to be a little bit more optimistic when it comes to that kind of stuff, but something needs to be done. And one of the things that we try to do at the firm is take a look at the overall plan, take a look at your income. So we follow a process, the RITE process, which, by the way, the show will be transitioning to the Right Retirement Show the first week of May. I think it's the 3rd is the first show. So we'll have the Right Retirement Show. But we look at the R for retirement income and really try to figure out how to be tax efficient there. It's as tax efficient as possible during that retirement income planning phase. And then take a look at the investments, how you're invested, the risk, the fees that you're paying. Do we have opportunities for some charitable giving and such? Really take a look at that. And then on the taxes side of things, how are we pulling income? What's the most efficient way to do that? Should we look at some Roth conversion strategies, or, are we taking into account charitable giving here as well to help lower our, current tax liability, and then also maybe potentially affect the future tax liability? And then, of course, estate planning. We want to make sure that your assets get to where you want them to go in the most tax efficient manner. And obviously we're not estate planners or attorneys, but we know how to ask some of the right questions to be able to understand if you have some improvements you need to do in that area. Again, that's on the report card as well. And then we'll refer you out to somebody if you don't have somebody. So that process is what we use when somebody comes into the office, and you can start it by calling 256-937-2010. Again, the number is 256-937-2010. I hope everybody's enjoyed the show. Graham, Luann, thanks for being here. Hope everybody has an awesome and blessed week. Happy Easter to everybody. Praise God for Jesus' resurrection. And we hope everybody has an awesome and blessed week. Take care.
AE Wealth Management, LLC provides services without regard to religious affiliation, and the views of individual advisors are not necessarily the views of AE Wealth Management.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.